In March 2020, something extraordinary happened. The U.S. economy shut down. Flights were canceled. Businesses closed. Markets crashed at record speed. And then, trillions of dollars appeared. Not from taxes, not from investors, not from foreign governments, from the Federal Reserve. Within weeks, the Fed expanded its balance sheet by amounts that previously would have taken years. Headlines said, "The Fed is printing money," and suddenly a question started spreading everywhere. Are they just creating money out of thin air? And if they are, what does that actually mean for you? Because here's the thing, when people hear money printing, they think of hyperinflation. They think of economic collapse. They think of countries like Zimbabwe or Venezuela. But the U.S. isn't Zimbabwe. So what's really happening? Why does the Federal Reserve print money? And what does it actually do when it does? Let's break it down. First, the Fed doesn't literally print most of it. Look, the image most people have is giant printing presses running non-stop, stacks of dollar bills flying off conveyor belts. That's not how it works. Physical cash makes up a small fraction of the money supply. When the Fed prints money, what it's usually doing is creating digital reserves, numbers on a balance sheet. Here's the point. Modern money is mostly digital. When the Fed expands the money supply, it isn't mailing people suitcases of cash. It's adding reserves to the banking system. And that changes everything. Why print money in the first place? Now here's the real question. Why would the Fed create new money in the first place? There are three main reasons: to stabilize financial markets, to stimulate economic activity, to prevent deflation or collapse. Let's unpack that. In a crisis, banks stop trusting each other. Credit freezes. When credit freezes, businesses can't borrow. When businesses can't borrow, they cut jobs. When jobs disappear, spending collapses. It becomes a downward spiral. This is exactly what happened during the Great Recession. The Fed stepped in and injected liquidity into the system, not because it wanted to inflate the economy, but because without liquidity, the system was freezing. Think of it like adding oil to an engine that's seizing up. Without lubrication, the machine breaks. How the Fed actually prints money. Here's where it gets interesting. The Fed doesn't just create money randomly. It does it through asset purchases, specifically through something called quantitative easing. Here's how it works. The Fed buys U.S. Treasury bonds from banks or financial institutions. In exchange, it credits those institutions with reserves, new reserves, created digitally. No taxpayer money involved, no prior savings required. It expands its balance sheet. Assets go up because it now owns the bonds. Liabilities go up because bank reserves increased. Money supply expands. Simple on paper, massive in impact. During 2008, this process stabilized markets. During 2020, it happened at unprecedented speed. The Fed's balance sheet doubled in months. That scale matters, because scale affects confidence, and confidence affects behavior. But does it cause inflation? Now we get to the fear. If you create trillions of dollars, doesn't that automatically cause inflation? Not necessarily. Here's the thing. Inflation isn't just about money supply. It's about money supply relative to goods and services. After 2008, the Fed printed trillions, but inflation stayed low for years. Why? Because demand was weak. Banks held reserves. Consumers were cautious. Money circulated slowly. Economists call this velocity. If money doesn't move, it doesn't create price pressure. But in 2020, the situation was different. The Fed printed. Congress spent aggressively. Consumers received stimulus checks, and supply chains broke down. So now you had more money, strong demand, limited supply. That combination fuels inflation, and by 2022, inflation surged to 40-year highs. The Fed then had to reverse course. Printing money is powerful, but it's a double-edged sword. Inject liquidity during a crisis, you prevent collapse. Inject too much liquidity for too long, you risk inflation bubbles, asset bubbles, market distortions. Low interest rates plus high liquidity often push investors into riskier assets. Stocks rise, housing surges, crypto explodes, and sometimes those gains aren't sustainable. So the Fed constantly balances. Too little intervention, recession risk. Too much intervention, inflation risk. It's never neutral. Does the Fed create wealth out of thin air? Here's a deeper question. When the Fed prints money, is it creating real wealth? No, it's creating liquidity. There's a difference. Liquidity makes transactions easier. It supports borrowing. It supports investment. But it doesn't create productivity. It doesn't build factories. It doesn't invent technology. Real wealth comes from output, from innovation, from labor and capital working together. The Fed can support the environment for growth, but it cannot manufacture growth itself. That's an important distinction, because when markets rally during QE, sometimes people assume the Fed made the wealth. What it actually did was lower the cost of money, and cheaper money often boosts asset prices. Now here's where it gets even bigger. The US dollar is the world's reserve currency. So when the Fed prints money, global liquidity increases. When the Fed tightens and reduces its balance sheet, global liquidity shrinks. Emerging markets feel it immediately. Currencies move, debt payments change, capital flows shift. So money printing in Washington can affect businesses in Asia, Europe, Latin America overnight. That's scale. That's influence. Money printing is controversial. Critics argue it distorts markets, that it increases inequality by boosting asset prices, that it punishes savers. Supporters argue it prevents depression, that without aggressive intervention in 2008 and 2020, unemployment would have been catastrophic. Both sides have points. But here's the reality. In a modern financial system built on credit, liquidity crises spread fast, faster than politics can react. The Fed acts because it can move immediately. No congressional vote, no legislative gridlock, just a policy announcement, and markets respond within seconds. That speed is its strength and its risk. Now here's something people overlook. The Fed can also unprint money through quantitative tightening. Instead of buying bonds, it lets them mature without reinvesting, or it sells them. This shrinks its balance sheet, reduces reserves, tightens financial conditions. After inflation surged in 2022, the Fed began doing exactly that, raising rates, shrinking the balance sheet, pulling liquidity out. And markets reacted. Because liquidity is like oxygen. Add too much, and things overheat. Remove too much, and growth slows sharply. So what does printing money really mean? Here's the point. When the Fed prints money, it isn't recklessly firing up machines in a basement. It's adjusting liquidity in the financial system. It's influencing the cost and availability of credit. It's stabilizing or stimulating during crises. But the consequences depend on timing. Print during collapse, prevent disaster. Print during supply shortages, fuel inflation. And that's the tension. The Fed doesn't control productivity. It doesn't control supply chains. It doesn't control geopolitics. But it controls liquidity. And liquidity shapes behavior. So when you hear The Fed printed trillions. Understand what that really means. It expanded its balance sheet. It increased bank reserves. It changed financial conditions. And those changes ripple into mortgage rates, asset prices, job markets, inflation expectations. Money printing isn't magic. It isn't harmless. It isn't automatically catastrophic either. It's a tool, powerful, complicated, and capable of stabilizing or destabilizing depending on how it's used. And the next time the Fed announces asset purchases, ask yourself, is this emergency stabilization or the beginning of the next inflation cycle? Because the difference between those two shapes the entire economy.